A sloth, a donkey, and a curious human. Send a prompt and see what they're doing. One hits record with a question on his mind. Two brothers pick it up, see what they find. Corn takes his time, Herman's got the facts. Back and forth, they never hold back. My weird prompts, come on in, that's where we begin. My weird prompts, glad you're here.
This episode was generated using artificial intelligence. Please verify facts.
My Weird Prompts is a community-driven initiative exploring how AI can fuel curiosity and uncover the fascinating ways our world works. GPU compute for this podcast is generously provided by Modal. Learn more at modal.com.
You ever stop and think about the fact that most of the world functions on a giant stack of promises that never actually intend to be kept? I was looking at the energy markets this morning, and it is wild how much of the global economy relies on people trading things they have no intention of ever touching. It is this massive, invisible layer of financial insurance that keeps the global economy from collapsing every time a tanker is delayed or a pipeline has a hiccup.
It is the ultimate invisible architecture, corn. Most people see the gas station price or the headlines about a tanker in the Middle East, but they miss the massive financial engine that actually keeps the lights on. If you think oil prices are just about supply and demand in the physical sense, you are missing the most important part of the story. Today's prompt from Daniel is about that exact machinery. He wants us to dig into the technical side of commodity derivatives, specifically how futures and options work in the petroleum industry.
It is a great prompt because it moves past the surface level. Oil is expensive, conversation, and gets into how these things function as insurance. I think there is this common perception that the people trading oil are just gamblers in suits, but for a huge chunk of the market, it is about survival and predictability, not just speculation. It is a paradox, really. Oil is one of the most volatile assets on the planet, yet for the people who know how to use these tools, it can be one of the most predictable parts of their budget.
That is the perfect place to start. I am Herman Poppleberry, by the way, for anyone joining us for the first time, and I have been diving into the clearinghouse data and the mechanics of these contracts all week. To understand this, you first have to separate the world into physical barrels and paper barrels. A physical barrel is the actual gooey, black stuff coming out of a well in West Texas or the North Sea. A paper barrel is a financial contract that represents the value of that oil.
And the ratio between them is staggering, right? I read somewhere that for every one physical barrel of oil that actually gets produced and refined, there are dozens, sometimes hundreds, of paper barrels being traded on exchanges like the New York Mercantile Exchange or the Intercontinental Exchange.
It is often over 20 to 1 depending on the day and the market volatility. And that is not because people are bored, it is because the world is trying to price risk. If you are a massive shipping company or a plastics manufacturer, you cannot afford to have your raw material costs double overnight because of a geopolitical flare-up. You need a way to lock in your costs months or years in advance. That is why companies treat oil as a financial instrument rather than just a raw material. They are managing a balance sheet, not just a warehouse.
Let us break down the foundational units here. We have futures and we have options. They sound similar to the uninitiated, but the legal obligations are worlds apart.
A futures contract is a binding agreement. If I enter a futures contract to buy 1,000 barrels of oil at $75 a barrel in 6 months, I am legally obligated to do that, regardless of what the market price is when the calendar flips. It is a symmetric obligation. Both the buyer and the seller are locked in. If the price goes to $100, the buyer is thrilled because they are still paying $75. If the price drops to $50, the seller is thrilled because they are still getting $75. It eliminates the unknown.
But an option is different. It is right there in the name. It is optional.
Precisely. An option gives you the right, but not the legal obligation, to buy or sell at a specific price, which we call the strike price. It is much more like a traditional insurance policy. You pay a premium up front for the right to protect yourself against a price move, but if that move never happens, you can just let the contract expire. You discard it, as Daniel put it in his prompt.
Let us get into the technical mechanics of that insurance policy, because I think this is where the real magic happens for a business. Imagine we are a massive logistics firm. We have thousands of trucks on the road, and we are planning our budget for the third quarter. We are terrified that oil is going to spike because of some new tension in the Middle East.
Okay, let us walk through that. As a logistics firm, you are worried about the price going up, so you buy call options. A call option gives you the right to buy oil at a set price, let us say $80 a barrel. This $80 is your strike price. To get this right, you pay a premium to a bank or a market maker. Let us say you pay $2 per barrel for that premium.
So, my all-in protected price is $82.
Now, let us look at the decision tree when those contracts reach maturity. Scenario 1. The price of oil spikes to $110 a barrel. Your trucks are now paying a fortune at the pump, but you have these call options. You exercise them. You demand your oil at $80. The person who sold you the option has to pay you the $30 difference per barrel. That check you receive from the financial market offsets the extra money you are spending on diesel. Your budget stays intact.
And scenario 2. The market stays calm, and oil actually drops to $70.
In that case, you discard the option. Why would you exercise your right to buy at 80 when the market price is 70? You just let it expire worthless. You are out the $2 premium you paid at the start, which is your insurance cost, but you are happy because your actual fuel costs are much lower than you budgeted for. You have effectively capped your downside while still being able to benefit from a price drop.
That is a crucial distinction. With a futures contract, if the price drops to 70, you are still stuck paying 80. You are protected from the spike, but you are locked out of the savings. The option gives you the best of both worlds, provided you are willing to pay that upfront premium.
And that premium is influenced by two big technical factors, delta and theta. Delta measures how much the price of your option moves in relation to the actual price of oil. If oil goes up $1 and your option goes up 50 cents, your delta is 0.5. Theta is the time decay. As you get closer to the expiration date, the option loses value every single day if the price is not moving in your favor. It is like a ticking clock. The more time you want for your insurance to be active, the more you have to pay.
This brings us to a really important technical detail Daniel asked about, the different types of barrels. Because if I am that logistics firm, I need to make sure my paper insurance actually matches the physical reality of the fuel I am buying.
This is where things get granular. Oil is not a monolithic commodity. The two big benchmarks are West Texas Intermediate, or WTI, and Brent crude. WTI is the American standard. It is a light, sweet crude, meaning it has low sulfur content and is easy to refine into gasoline and diesel. Brent is the global benchmark, sourced primarily from the North Sea.
And they settle differently, right? One is physical, one is cash.
That is the huge technical divide. WTI is famous because it is a physical delivery contract. If you hold a WTI contract until it expires, you technically have to take delivery of those barrels at a terminal in Cushing, Oklahoma. This is why we saw oil prices go negative back in April of 2020. The storage tanks in Cushing were full, and people were literally paying others to take the contracts off their hands so they would not be legally forced to show up with trucks they did not have to collect oil they could not store.
That was a legendary moment of market mechanics colliding with physical reality. But Brent is different.
Brent is primarily cash settled. It is waterborne, meaning it can be put on a ship and sent anywhere in the world, which makes it the global benchmark. Most of the options and futures used for international hedging are based on Brent. But here is the catch for our logistics firm. If you are hedging with Brent futures, but your trucks are running on a specific grade of diesel in the American Midwest, there might be a price gap between your hedge and your reality. We call that basis risk.
Basis risk sounds like the kind of thing that keeps chief financial officers awake at night. If the hedge does not perfectly match the reality, you are still exposed. You might be insured, but the insurance company is paying out in a currency you cannot use, or at a rate that does not cover your actual loss.
And it is not just logistics firms. Daniel asked who else is in this market. We always talk about airlines because they are the most visible. Fuel is often their single largest expense. But think about agricultural conglomerates. If you are a company like Archer Daniels Midland or Cargill, you are exposed to oil prices in two ways. First, the diesel for the tractors and the ships. Second, fertilizer. Most nitrogen-based fertilizer is produced using natural gas. These companies are deep in the derivatives markets for both oil and gas, just to make sure they can put a price on a bushel of corn 6 months before it is even harvested.
Or think about the manufacturing sector. Plastics, chemicals, synthetic fibers. They all start as petroleum feedstocks. If you're a company making plastic bottles, oil is not just the fuel for your factory, it is the actual raw material. If the price of ethylene or propylene spikes because oil is volatile and you have not hedged that risk, your profit margins can vanish in a single quarter. These organizations are often just as active in the swaps and options markets as the big oil producers themselves.
And then you have the sovereign wealth funds and national governments. Mexico is the gold standard here with what they call the Hacienda Hedge. Every year, the Mexican government spends billions of dollars buying put options, which are the opposite of call options. A put option gives them the right to sell their oil at a guaranteed minimum price.
So if the global price of oil crashes to $30, Mexico still gets to sell theirs for, say, $60.
Since their national budget is heavily dependent on oil revenue to fund schools, hospitals, and infrastructure, a price crash could be a national catastrophe. By buying these options, they turn a catastrophic risk into a predictable insurance premium. It is one of the largest and most secretive financial maneuvers in the world every year.
I want to talk about the who on the other side of these trades, because if an airline or the Mexican government is buying insurance, someone has to be selling it. Someone has to be willing to take on that risk. Who is the counterparty?
This is where the market gets its grease. It is rarely a perfect match where an oil producer wants to sell at the exact price an airline wants to buy. That is where the market makers and speculators come in. A big bank like Goldman Sachs or JP Morgan or a specialized commodity hedge fund will act as the counterparty. They will sell the call option to the airline.
But wait, why would a bank want to take on the risk of oil going to $120? They do not have oil wells. They do not want to be on the hook for that price spike.
They do not hold the risk. This is the secret of the professional trading desk. As soon as they sell that call option to the airline, they go out and hedge the hedge. They use those complex mathematical models we mentioned to buy a certain amount of oil futures to offset the risk they just took on. They are trying to earn a small fee on the transaction while keeping their net exposure to the price of oil as close to zero as possible. They are basically acting as a high-tech insurance broker.
And then you have the speculators. These are the people who actually wants the risk.
And we need them. Without speculators, the market would be incredibly brittle. If the only people trading were companies trying to hedge, there would be huge gaps in the market where nobody wants to trade. Speculators provide liquidity. They are the ones who are willing to take the other side of the airline's trade because they think oil prices are actually going to fall, and they want to pocket that premium the airline is paying. They are betting that their analysis of supply and demand is better than the market's current price.
But what happens when things go wrong? If I am an airline and I have $1 billion worth of options that are now in the money because oil spiked, I need to know the person who sold them to me can actually pay up. We saw what happened in 2008 when counterparty risk became a reality.
That is where the clearinghouse comes in. This is one of the most important innovations in modern finance. When you trade a contract on an exchange, you are not actually trading with the other person. The clearinghouse steps in the middle. They become the buyer to every seller and the seller to every buyer. They guarantee the trade.
How do they make sure they do not go bust if a major player defaults?
Margin. To trade, you have to post collateral called margin. If you are losing money on a trade, the clearinghouse takes money out of your account every single day to cover those losses. This is called marking to market. If your account balance drops below a certain level, you get a margin call. You either put in more cash immediately, or the clearinghouse closes your position and uses your collateral to pay the winner. It prevents a domino effect of defaults.
So the systemic risk is managed by making sure everyone is constantly paying for their losses in real time. You cannot just hide a massive loss and hope it goes away.
Not in the regulated futures markets. That is why these markets are actually quite resilient. Even during the massive volatility we saw recently, like the coalition strikes against Iranian oil infrastructure we talked about in episode 1009, the clearinghouses held up. The financial pipes did not burst because the margin system forced the losers to pay up every day as the price moved.
I want to pivot back to the geopolitical side, because Daniel's prompt touches on how these things work in practice. We have talked before about the Strait of Hormuz, episode 946, for those who want to go back. That one narrow waterway handles approximately 20% of the world's daily petroleum liquids. When there is a threat there, the options market reacts before the physical oil even stops moving. Why is that?
Because options are a bet on future volatility, not just future price. There is a technical term called implied volatility. When people get nervous that something might happen, like a tanker being seized, they rush to buy protection. That increased demand for insurance drives up the price of options. It is like trying to buy fire insurance while you can see smoke coming from your neighbor's house. The premium goes through the roof.
So you can actually look at the options market as a kind of early warning system.
You look at the volatility skew. If people are paying way more for call options than put options, it tells you the market is terrified of a price spike. It is a much more nuanced way to read market sentiment than just looking at the daily price move. It is the difference between seeing that a car is moving and seeing how hard the driver is gripping the steering wheel.
I find it interesting how this relates to the newer platforms we are seeing, like Polymarket, which we discussed in episode 1107. There, people are betting directly on whether a war will start. How does that compare to the commodity markets?
It is a great contrast. Polymarket is an event-based prediction market. It is very binary. Either the event happens or it does not. Commodity derivatives are much more continuous and integrated into the physical economy. An oil future is not just a bet on a war, it is a bet on the complex interplay of refinery capacity, shipping rates, global demand, and currency fluctuations. It is a much thicker market with more information being processed. But we're starting to see those worlds merge. High-frequency trading firms are now using sentiment analysis from event markets to inform their oil trades.
So the insurance is getting smarter, but is it getting better? Because if everyone is using the same algorithmic models to hedge, does that not create a new kind of risk? Like a flash crash where everyone tries to exit the door at the same time.
That is a major concern for regulators. When you have massive amounts of capital being managed by the same types of delta hedging algorithms, they can all decide to sell at the same moment. We saw a version of this in 2020. It can overwhelm the liquidity of the market. The clearinghouses have circuit breakers to stop the bleeding, but the speed of the modern market is definitely a double-edged sword. It makes hedging cheaper and more accessible, but it also makes the system more prone to sudden, violent moves that have nothing to do with how much oil is actually in the ground.
Let us get into some of the practical takeaways for people who want to understand this better. If you're looking at the news and you see oil prices hit $85, what should you actually be looking for to see the hidden story?
The first thing I always check is the term structure. Is the market in contango or backwardation? These are fancy words for a simple concept. Contango is when the price for delivery in the future is higher than the price today. This usually means there is plenty of oil around and people are paying to store it. Backwardation is the opposite. The price today is higher than the future. That is a sign of extreme tightness. It means people need oil right now and are willing to pay a premium to get it immediately.
So, backwardation is the emergency signal. It is the market screaming that the physical supply is lagging behind demand.
The second thing to look at is open interest. This is the total number of outstanding contracts that have not been settled. If open interest is rising while prices are rising, it means new money is flowing into the market and the trend has legs. If open interest is falling while prices are rising, it might just be a short squeeze. People being forced to close out losing positions, and the move might not last.
And for the average person, why does this discard versus exercise logic matter?
Because it explains the cost of energy. When you see an airline announce a massive profit even though fuel prices went up, it is because they did not discard their options. They exercised them or sold them for a profit that offset their costs. It helps you understand that these big corporations are not just at the mercy of the wind. They are active participants in managing their destiny. It also teaches you about the cost of carry. Holding an option or a future is not free. You are paying for the time, the margin, and the opportunity cost.
I think it is also a good reminder that the speculators are not the villains they are often made out to be. If you want to be able to buy a plane ticket at a fixed price 3 months from now, You are benefiting from a speculator who is willing to take the other side of that airline's hedge. Without that person willing to buy the risk, the airline would have to charge you a massive premium just to cover the uncertainty.
It is a symbiotic relationship. The market is a giant machine for processing information and distributing risk to the people most willing to bear it. When it works, it is beautiful. When it breaks, like it did in the negative price era, it exposes the weird, messy plumbing that connects our financial digital world to the physical reality of oil tanks in Oklahoma.
We have covered a lot of ground here, from the paper barrels to the basis risk to the Hacienda Hedge. It really paints a picture of a world that is much more insured than most people realize. Hedging is not about making money. It is about eliminating variance. It is about making sure that a business can focus on its actual job flying planes, making plastic, or growing corn, without being wiped out by a price move they cannot control.
It is. And that insurance is what allows for the long-term planning that drives the modern economy. Without these derivatives, you could not build a massive chemical plant or run a global shipping fleet. The volatility would simply be too high to attract the necessary investment. As we move into an era of more algorithmic trading and potentially more geopolitical volatility, understanding these mechanics is only going to become more important. The speed at which these paper barrels move is only increasing.
So, the takeaway is, do not mistake the insurance for the underlying asset. But do not ignore the insurance either, because it is what is actually setting the price you see at the pump.
The financial layer and the physical layer are in a constant dance. Sometimes one leads, sometimes the other, but they are always connected by these contracts.
I think we have given Daniel a pretty thorough breakdown of his prompt. It is a complex topic, but once you see the insurance logic, a lot of the weirdness of the oil market starts to make sense.
It really does. Once you start looking at open interest and volatility skew, the news starts to look a lot different. You stop seeing just prices and start seeing risk management.
Well, I am definitely going to be looking at the term structure next time I see a headline about oil. It is like having a secret decoder ring for the global economy. Before we wrap up, I want to say a huge thanks to our producer, Hilbert Flumingtop, for keeping all the technical gears turning behind the scenes.
And a big thanks to Modal for providing the GPU credits that power this show. We could not do these deep dives without that infrastructure.
If you found this breakdown helpful, or if it just made you realize how much more complex the world is than it looks on the surface, we would love it if you could leave us a review on your favorite podcast app. It really helps other people find the show and join the conversation.
This has been My Weird Prompts. We will be back soon with another deep dive into whatever Daniel throws our way.
See you then.
Take care.
This episode was generated using Gemini Flash 3. Text-to-speech engine was Chatterbox.
Thanks for listening to our show, My Weird Prompts, where our thoughts go from slow takes to facts on cue. We change and follow through. My Weird Prompts, that's the close from sloth, from man, from long-eared host. My Weird Prompts, until next time, stay curious, keep weirding.